the moment, that is all from here, but stay tuned because in a couple of minutes we'll be talking to Nouriel Roubini here out of Brussels. For that, back over to you, Lou.
Annette, good to see you again. Thank you very much for that. Gemma's still with us in the studio as our guest host, as you know. Gemma, what do you do when you look at the overall situation of whether it's good to let a country go under or not? Would it be better just to let the weak fail, and that accounts for the banks as well, versus saving them?
I mean, it's always important to look at what's going to actually happen, what are going to be the follow-on effects from actually letting a country go into default and exit. And actually, obviously, you know, one of the main areas that people are looking at the moment is in Europe. You know, why don't we just let, just like we let Lehman Brothers go, why don't we actually just let Greece default? Yeah. But there are so many intertwining connections and so many intertwining holdings. I mean, as I mentioned before, you know, a lot of German banks actually have exposure to the PIGS country in excess of 18% of their GDP. So it would wipe off 18% of their GDP if the periphery countries decided to leave and default on their debts. So there's a lot that has to be taken into account, and also short-term and long-term horizons as well.
We've got this debt swap though. I mean, which is a sort of a taking a haircut on Greek debt, and we now have a condition 90%. Of course, it's got to be accepted on that, which has raised the bar. At the same time, we've got collateral demands. The Troika's pulled out. What's your own view on? It's funny because we're concentrating on Italy on the one hand, but we still have Greece running away in the corner. We don't know if that goes uncontrolled. We don't quite know what the implications are.
I mean, the governments aren't doing anything to regain investor confidence. So if you look at Greece, there's a lot of question marks at the moment as to whether there's going to be a second bailout, because they've actually missed their targets for the first. So there's still a lot of uncertainty there.
It's a clear sign austerity is killing their, the austerity needed to earn the and money is killing their economy. Austerity
doesn't foster growth, and growth is needed to help these economies get out of this situation. If you look at, debt can't be used to solve a problem of debt, and you've got debt divided by GDP, and these are the figures that people are focusing on. And if you've got the debt burden increasing and the denominator not moving, the situation's getting worse. And as you rightly pointed out, if you're cutting spending, you're doing nothing to boost consumption and demand, it looks like there's a very bleak outlook.
Let's bring in Stuart Richardson, his partner at IMG Wealth. You're sitting here, Stuart, so I'm going to jump the rundown and bring you straight in, because I know you'll have a view on this. On a heavy selling day, we're worried about everything today. Where can we clutch at straws?
I think the world changed back in the summer, and there's a sort of point of recognition in the markets in the big picture, to the point where we're talking about Greece. Do we try and continue to restructure and force austerity on these countries, or do we just cut them loose and let them devalue, restructure and write down the debt and start again, like in a similar way we did, or the markets did with Iceland? And with that recognition point, we come back to the amount of debt on the books, we come back to how well the banks are capitalised, and frankly, there's just the European banks are very, very poorly capitalised, and either need a lot more capital or a political solution to basically try and wipe over those debt problems. So we think in terms of grasping at straws, in the short term it might be a little bit late, but people have to look to improve the quality of their portfolios.
Stuart, you're staying with us for a moment. We just want to bring in another voice into the conversation. Nouriel Roubini is the co-founder and chairman of Roubini Global Economics. Nouriel, good to see you. We're discussing here in the studio all the red that we're seeing on our screens, a big sell-off day here in the Eurozone. And what happens if we take our eye off one of the initial balls, namely that of Greece, because we're so focused on what's going on in Italy? What are your initial thoughts?
Well, my initial thoughts are that, first of all, there is now a serious risk of another recession in the Eurozone, in the US, in the UK, and markets are getting worried about that, and that's a significant risk. I assign a 60% probability to it. Secondly, of course, the sovereign debt issues in the Eurozone are becoming much more severe. Still a little of political and policy uncertainty from Spain to Italy. Condition of European banks are under stress because of exposure to the sovereign, now funding problem, and now there is a massive amount of risk aversion. So this is a critical time, and we need a completely new set of economic policies in the US and the Eurozone to prevent another meltdown.
Nouriel, many viewers writing in wondering pretty much the same question. Tim Right, so would it not be better for Greece to be kicked out of the euro now that they only account for some 2% of turnover, and instead of buying any more Greek bonds, then the sovereign could refinance their banks when they have to write off the debts that they lent to Greece? Would it be a better option to let Greece go its own way and to break up the Eurozone?
Well, at this point, I think that the problems in the Eurozone go well beyond Greece. Greece is already doing a restructuring of its public debt. 20% haircut was not sufficient. Eventually, it's going to have to be 30, 40, 50. And Greece could even leave the Eurozone. But at this point, whether they leave the Eurozone or not is not really critical to the fact that now you have problems from Greece to Ireland, to Portugal, to Italy, to Spain, to Belgium, to French banks, to German banks, and so on. So whether Greece stays or not in the Eurozone at this point is the last of the problems of the Eurozone, if I had to say something.
Yeah, Nouriel, Ross, nice to see you again. It seems like only yesterday that I was with you in Como. How credible is it that Italy might, at some point, default? I mean, seriously, what are the chances of that actually happening?
Well, for the time being, I don't think Italy is going to default, and I think that while an orderly restructuring of the Greek debt was feasible because it was only 100 billion euros of money at stake, in the case of Italy, we're speaking about 2 trillion. I think Italy has to do its fiscal austerity. Even if they do it, markets are going to be nervous about the credibility of this government, and many other things have to happen. One of them is that Italy has to change government. I think that if Berlusconi was gone, tomorrow Italian spreads, even with the same policy, will be 50 to 100 basis points lower. There is a crisis of confidence in this particular government, even if they try to do the fiscal adjustment. There is also need of financial support from the EU for Italy. For now, the ECB is doing just a bridge until the EFSF is approved. Even when the EFSF is approved, they're going to run out of money if they have to backstop Italy and Spain. Therefore, either you double or triple the EFSF resources, or otherwise, unless there is also the idea of Eurobonds, Italy and Spain could have a self-fulfilling run in a situation in which illiquidity can lead to insolvency, even if the country is not insolvent, just because the market panics and pushes the spreads to levels that are unsustainable. So if you believe that Italy and Spain are solvent, they still need official money to avoid a bad equilibrium, because it will be like a bank run on the sovereign rather than on the bank.
But at the moment, we still believe that that's an unlikely, it's a more unlikely than likely scenario that you've painted out. And I'm just trying to go to where the most likely thing to happen is, and wonder whether we can move forward from that point.
Well, either the ECB is going to do the dirty job, but they already said we don't want to monetize this deficit. We're giving this money to Italy and Spain while the Europeans decide to pass the EFSF. Even if the EFSF is passed by the national governments, they're going to run out of money given the pressure on Italy and Spain. Then you need either to triple the EFSF or do the Eurobonds, because if you don't do any of those things, then what happened in Greece that was supposed to be unique and exceptional, an orderly but coercive restructuring of the public debt, would become not an exception but the rule. Would happen in Italy and Spain. In Italy and Spain, we're speaking about 3 trillion euros of public debt, not 100 billion of Greece. So orderly can be done in Greece with limited losses for the banks, but if you have to do it for Italy and Spain, then it will be a severe financial disaster for European financial institutions. So we have to avoid that bad equilibrium from occurring. Countries have to do the right thing, but also Europe has to help them. And I think there's another critical point here is the critical. It's not enough to do fiscal austerity, because if you don't have economic growth, you can try to reduce debt and deficits, but if the denominator is collapsing, then you're not going to achieve that sustainability. And you cannot have growth coming back in 3 years from now with medium-term fiscal austerity. You need growth today. And to have to grow today in the Eurozone, you need the ECB to reverse the biggest mistake they've done in the last 10 years, increasing interest rates as they did this spring. That was a huge mistake. They have to cut rates to help the periphery. You need to have a weakening of the value of the euro. They'll be consistent with a weaker interest rates in the Eurozone, because the strong euro is hurting the competitiveness of the Eurozone. And the countries in the core have to do fiscal stimulus if the periphery is doing fiscal austerity, because fiscal austerity everywhere, as Lagarde said, is going to kill the global recovery. So we need fiscal stimulus in US, in UK, in Japan, in the core of the Eurozone. Otherwise, Otherwise, it'll be a severe crisis worse than last time around.
Nouriel, very briefly, we have less than 30 seconds. Should the EFSF money be spent directly to shore up banks? Would that make a difference? And wouldn't we be keeping ourselves in the same conundrum if the ECB were to cut rates?
Well, certainly I am of the view that, yes, the EFSF money should be used like in a TARP-like scenario to backstop all European banks that need money, because if they do it, the stigma is not going to be there if it's given to lots of different banks. And there is a disagreement between the Europeans and the IMF on how much capitalization are needed, but the market believes that those recapitalization needs are there and they are large. So just to contain the market lack of credibility, a European-wide use of the FSF will be necessary. On the ECB, the point is that we need easier monetary policy. The tightening by the ECB was a mistake. Reducing rates and commitment to reduce them even more is going to restore some credibility that the Europeans are helping themselves also on the monetary side. And Trichet has to do it, because if he doesn't do it this week, then it's up to Draghi the first time he comes in his first meeting to do it, and that will be politically more difficult. So the ECB has to signal this week they're going to cut rates, and that's going to help to restore the confidence.
We'll have to wait until Thursday to see if you're right and if they're listening to you. Thank you for being with us. Good to see you. I didn't see you at the Ambrosetti Forum like Ross did, but maybe next year. Nouriel Roubini, co-founder and chairman of Roubini Global Economics. It was a nice trip, though, wasn't it?
It's worth pointing, Nouriel did make that call at Ambrosetti that ECB needs to cut rates, and he said it with Trichet sitting 3 places away from him.
Maybe he is listening.
Not much reaction from Jean-Claude.
He's on his way out, right? So, coming up here on Closing Bell, though, we will get some final comments with Gemma and Stuart, both of us, both of them and us, still in the studio. Send your emails through the European Closing Bell at cnbc.com. Keep them coming. Find us on Twitter at Louisa Boyes or at Ross Westgate.